Here's an uncomfortable truth. Humans were not designed to be good traders. Every instinct that kept your ancestors alive for millions of years actively sabotages your trading performance. Your brain, which evolved to keep you safe in a physical world of immediate threats, is completely mismatched for the financial markets. Now, the fight or flight response that saved your ancestors from predators now destroys your portfolio. The pattern recognition that helped early human beings identify food sources now creates false signals in market noise. Now, here's the brutal reality. 95% of retail traders lose money, not because they lack intelligence or education. They lose money because they're fighting against millions of years of evolutionary programming. Your brain literally works against you in the markets. Now, once you recognize the specific ways your brain sabotages your trading, you can start building systems that work with your psychology rather than against it. Today, we're exploring the evolutionary mismatch between human psychology and trading success, and how to overcome these built-in programs. Let's begin. Human psychology evolved to solve problems that have nothing to do with trading financial markets. Immediate threat response served our ancestors well when dangers were physical and required immediate action. This instant threat response now triggers every time you see red numbers in your trading account. Your brain treats financial losses as physical danger, flooding your system with stress hormones that really affect rational decision making. Now, linear thinking developed because most real-world cause and effect relationships are straightforward. This makes you expect that good analysis should immediately lead to profitable trades, and when it doesn't, you assume that something is wrong. Markets operate on complex principles where good decisions can produce bad short-term results. Pattern-seeking behavior helped early humans identify food sources and avoid dangers. Now, in trading, this creates the illusion of predictability in random market movements. You see support and resistance levels in normal volatility and trends in what might be pure noise. Risk aversion made sense when resources were scarce and losing your food supply meant starvation. This now makes you take profits too early whilst holding losing positions too long. Short-term focus developed because immediate survival took precedence over long-term planning. This makes you obsess over daily trading results rather than focusing on long-term goals. Now, these evolutionary mismatches explain why trading difficulties aren't personal failings. They're predictable responses from psychology designed for a completely different environment. Trading requires cognitive abilities that directly conflict with your brain's emotional and survival systems. The limbic system controls emotions and survival responses. When you're losing money, it activates fight or flight responses that shut down rational thinking. Your heart rate increases, stress hormones flood your system, and your capacity for objective analysis disappears. Now, the prefrontal cortex. This handles rational analysis and impulse control. Unfortunately, it's slower than the limbic system and gets suppressed during emotional stress. Now, it's really important to understand how your brain works. When you most need rational thinking during losses, your brain is least capable of providing it. Cognitive biases emerge from this conflict, like confirmation bias makes you seek information that supports your positions. Recency bias makes recent events feel more important. Now, time horizon confusion occurs because your emotional brain operates on immediate timescales, whilst trading requires longer-term thinking. And then, of course, we've got decision fatigue, which accumulates as your prefrontal cortex becoming exhausted from fighting emotional impulses. Stress-induced tunnel vision narrows your attention during high-pressure situations. When stressed about losing trades, you focus intensely on immediate problems whilst losing sight of the bigger picture. Now, the fundamental challenge here is that trading requires rational, thinking while your brain provides emotional survival-based responses. Now, let's talk about loss aversion, because perhaps it's one of the most destructive psychological bias for traders. The mathematics of loss aversion show that people feel losses roughly twice as intensely as gains. This makes you naturally inclined to avoid losses even when taking them would be profitable long term. Now, in trading, this translates to holding losing positions too long whilst cutting winning positions too short. Risk seeking in losses occurs when you're already down. When losing, you become willing to take larger risks to avoid realizing the loss. This explains why traders often increase position sizes when losing or make desperate trades to get even. So, mental accounting. This causes you to treat money differently depending on its source. Profits feel like play money, whilst original capital feels more valuable. And then, of course, regret avoidance. It drives you to make decisions based on avoiding future regret rather than maximizing outcomes. So, loss aversion affects every aspect of trading psychology and explains why most people find it nearly impossible to follow profitable strategies consistently. Human pattern recognition abilities create serious problems in trading environments where patterns are often random. Now, let's talk about confirmation bias. It makes you focus on information that supports patterns you think you've identified whilst ignoring evidence. Clustering illusion makes random events appear to occur in meaningful clusters. You see winning streaks and losing streaks in purely random results. And then you've got hindsight bias. This makes past movements appear more predictable than they were. Looking back at charts, patterns seem obvious and you wonder why you didn't see them in real time. Narrative fallacy drives you to create stories that explain random market movements. Your brain creates logical sounding narratives that connect unrelated events that have no value. The problem isn't that pattern recognition is useless, it's that human brains apply it differently, finding signals in noise. Social instincts that ensured survival become liabilities in trading. Now, for instance, herd mentality. This drives you to follow the crowd. In markets, this manifests as buying when everyone else is buying and selling when everyone else is selling. Social proof makes you assume other people's actions reflect correct behavior. This often leads you to adopt popular strategies at exactly the wrong time, when they're most crowded. Authority bias makes you defer to supposed experts even when their track record justify it. FOMO, the fear of missing out, emerges from social comparison. Seeing others trade or seeing other traders win creates urgency to participate, driving poor timing decisions. Please remember this. Status seeking through trading results creates pressure to generate impressive returns. Now, this generally leads to taking larger risks or focusing on short-term results rather than consistency. The comparison trap makes you measure success against other traders. Now, this can cause imposter syndrome. Profitable trading often requires just solitary decision-making that goes against social instincts. The real work here is developing systems that compensate for built-in disadvantages. So what do I mean by this? Well, systematic approaches, they remove emotional decision-making by predetermining responses to market conditions. Make decisions during calm periods when your rational mind functions better. Written trading plans and systematic criteria prevent your emotional brain from overriding rational analysis. Good risk management protects you from loss aversion and emotional decisions. Stop loss rules, position sizing rules, put these in place because they are going to be your safety nets. Emotional control and regulation techniques really help you to manage your psychological stress responses. Breath work, as I've mentioned many times, meditation, even physical exercise really help maintain calm mental states. The goal is building systems that work with your psychology rather than against it. Profitable trading requires systems that compensate for psychological limitations. Now, pre-commitment strategies involve making trading decisions before emotional pressure influences them. Write your trading plan when markets are closed and when you're thinking clearly. Execution rules eliminate flexibility that allows emotions to override systematic approaches. So, if X happens, I will do Y. Rules remove the judgment calls that emotions can influence. Record keeping, journaling, focuses attention on long-term performance rather than short-term. Environmental controls eliminate sources of emotional disturbance or interference. Turn off the financial news when you can and social media when you're trading. So, performance attribution analysis. This separates skill-based results from luck-based skills. Now, successful trading systems must be designed to work despite human psychology, not because of it. So, let's talk about how you can implement and start to change your psychology to improve your psychology, your personal evolutionary plan. You may want to take notes here. So, transforming from psychological driven to systematical driven trading requires a structured approach. So let's look at this now. We'll look at this as phases. So phase 1, awareness building. So you can do this weeks 1 to 4. And the first thing is track emotional responses to winning and losing trades. Journaling is one of the most amazing things you can do as traders. It just brings in so much data and knowledge. Identify your triggers that cause you to deviate from your trading plan, such as losses or market reversal. Now, phase 2 is system design. This can be weeks 5 to 8, and you don't have to do as many weeks. You can shorten this down to weekly. So phase 2, system design. Create written rules that address your psychological weaknesses. Design systematic stop loss and profit taking rules that remove discretion, unless of course you're a discretionary trader. Phase 3 is mechanical implementation. Now this could be weeks 9 to 16. As I said, you can just do this in a shorter period. Practice following systematic rules during small position sizes. This starts to build consistency and neural pathways in the brain. Focus on mechanical execution rather than profitability. Always focus on your process. Phase 4, stress testing. This could be weeks 17 to 24. However, again, you can do it shorter. Gradually increase position sizes to create moderate emotional stress whilst maintaining systematic execution. So phase 5, integration, weeks 25 to 52. So of course, just do this weekly if you wish. Now, combine systematic execution with normal position sizes whilst maintaining detailed performance tracking. So daily practices are start each session by reviewing your rules rather than market analysis. End each session by evaluating rule following performance rather than financial results. And of course, going back to your market analysis, it depends on what type of trader you are. So it's entirely up to you. Now, weekly reviews. Assess how well you followed your systematic approach regardless of outcomes. Now, there's a reason for all of this. It helps to build consistency and discipline. Now, the last one is success metrics. Measure consistency of systematic execution rather than just profitability. This evolution typically takes 6 to 18 months of consistent practice. Embracing your human limitations. Now, the final step isn't overcoming your humanity, it's accepting psychological limitations whilst building systems that work within these constraints. Acceptance over elimination. This means acknowledging you'll always experience emotional responses without trying to become emotionless. The goal is systematic execution despite emotions, not elimination of emotions. Realistic expectations about the difficulty of systematic trading helps you maintain motivation even during challenging periods. And gratitude for the challenge. This helps to reframe trading difficulties as opportunities for psychological development. Now, the ultimate insight is that humans are designed to be good traders, but humans are capable of designing systems that make them good traders. Your evolutionary psychology will always create challenges, But understanding these challenges allows you to build good systems. Successful traders aren't those who overcome their humanity. They're the ones who build the most effective systems for working with human limitations. The path forward. Your journey starts with accepting a fundamental truth. You're not broken, you're not a failure, you're just human. Start with self-awareness rather than self-improvement. Understand your psychological patterns before trying to change them. Build systems gradually. Measure progress differently by tracking systematic execution rather than just your financial results. Now, remember the bigger picture that trading psychology skills transfer to every area where you must make decisions under uncertainty. The path forward isn't about fighting your human nature. It's about building systems that work so well within your limitations that trading success becomes inevitable. You don't need to become a different person to become a successful trader. You need to become a systematic person who happens to trade. Your evolutionary psychology will always create challenges, but your human intelligence can always design solutions. Start today, start small. Best of luck.